Advanced Finance Group number 10. First of all, we selected the gold index from all the available indices in the Yahoo Finance Services. Originally, this index contains more than 40 stocks. However, most of these stocks were created in the interim of our study time period, which is from January 2000 to August 2013. So at the end, we just keep the 13 stocks that had all the available and required data. Uh, First, thanks to R, we compute and we plotted the excess returns from our industrial portfolio, which is an equally weighted portfolio, as well as for the AEM stock and the BVM stock. What is interesting here is to observe the high volatility presented in all three graphs, explained mainly because the financial crisis and the goal being as safety investment for high risk averse investors. Also, it is interesting to see the high correlation of all these three lines. We also compare the excess returns that we obtained with the US economy. To do so, we use the Dow Jones Industrial Index, the Standard & Poor's 500, and the Nasdaq indexes as a benchmark to the behavior of the US economy. We can see here two periods of high volatility, especially in the years 2002 and 2003. Some years after the dot crisis, and in the period 2008 and 2009, which, as we already know, it was the financial crisis. So this crisis can explain the downwards movement in both graphs, and the pick up can be explained, as we said, for two factors: the price of the gold that goes up in times of financial distress, and also in line with this is the desire of the investors to acquire safety investments.
Here we show the efficient frontier focusing only on risky assets. And you can see that the industrial portfolio does not lay in this frontier. This is because when you have different stocks with different levels of expected return and different levels of variance, as an investor, you would like to invest more in those assets that have more expected return per unit of risk, and less in those stocks that have less expected return per unit of risk. So holding a portfolio, an equity weighted portfolio, would be irrational, because it would generate a big cost of opportunity for the investor. Here we show the efficient frontier, including the risk-free rate. This frontier can be constructed by graphing and plotting the frontier between the risk-free rate and dependency portfolio. These two frontiers, you see in this graph, should touch each other in one point. And as you see, they do not touch. But this is because the dependency portfolio, which is the point where these two frontiers touch, is far away. Now, in this graph, we plot the same frontiers, but we show where they touch. They touch in the dependency portfolio in the red dot. And this dot is located in the point 3.79,1.13. This is a very strange dependency portfolio and a very strange result. kind of tried to explain it, and we concluded that a possible explanation for this tendency portfolio is that the crisis of 2008 and 2009 changed significantly this industry. To prove if this crisis indeed had an impact in this industry, we decided to split the data into two different time periods. The first time period is between January 2000 and December 2007. It is before the crisis, and the second period is between January 2008 and August 2013. Here we plot the two frontiers and tendency portfolio for the period before 2008. And we can see that the tendency portfolio is normal within the results we would expect in this model. And this can tell us that the market and the industry behaved normally before the crisis. Now, taking the data of the second period, the 2008 and 2013 period, we can see that the tendency portfolio is very abnormal. It has a negative Sharpe gradient, and this can indicate that during the crisis and after the crisis had a significant impact in this industry, making the results become abnormal. According to us, the panic and the change in the risk perception caused by the crisis can or could have made that the agents behave in an irrational way. So the results would be abnormal, and the model would not explain entirely the results.
All right, here we have the frontiers implied by S&P 500 and the risk-free rate, and also the industrial portfolio and the risk-free rate. First, what we notice is that both frontiers have the same intercept, but they have a slight different slope. This means that the S&P 500 frontier has a more Sharpe ratio than the one with industrial portfolio. This means that the portfolios that are included in the S&P 500 frontier have better returns per unit of risk, meaning that it's better for the industry. Okay, following we wanted to check if the capital asset pricing model holds, with having S&P 500 and the industrial portfolio as proxies for market portfolio, which is two stocks, AEM and BBN, and we're going to show our results. First, these are our results with the industrial portfolio as proxy, and following we have our results as with S&P 500 as a proxy. We can check again and see that the first one, the industrial portfolio as proxy, fits better the data than the S&P 500. Even though when checking both of these results, we can confirm that they are a rough approximation, because even though they capture the trend of the observations, we can see that they don't fit pretty much all the expected returns.